All right, so are we strapping in for a bull market or bracing for impact in 2025?
Well, that is the million-dollar question, isn't it?
It is, and luckily for us, we've got the Motley Fool's analysis of Wall Street predictions to use as our roadmap for this deep dive.
Oh, yeah. Those guys always have their fingers on the pulse of the market. It's going to be interesting to see what they dug up.
For sure, especially considering the market's already had quite a year. The S&P 500 climbed a whopping 23% last year, and it's already up almost 3% this year as of January 29th.
You know what's fascinating, though? Even with that stellar performance, most analysts are still predicting more growth for 2025.
Hold on, even with the S&P at what some might call a historically high valuation, analysts aren't pumping the brakes.
Nope, not really. The Motley Fool looked at predictions from some heavy hitters like JP Morgan, Goldman Sachs, Bank of America, and the median target they set for the S&P in 2025 is 6,600.
6,600. Whoa, that's a potential 9% jump from where we are now. So if you invested $10,000 today, you could potentially be looking at close to $11,000 by 2025. That's pretty enticing.
It is definitely something to think about. But before we get too excited, let's dig into why analysts are so bullish. What's fueling this optimism?
Yeah, are they just drinking a Kool-Aid? Or are there some solid reasons behind these rosy predictions?
Well, there are actually a few key factors that are contributing to this bullish sentiment. First off, projected GDP growth is looking pretty good right now.
Okay, so the economy as a whole is expected to keep chugging along.
Exactly. And on top of that, inflation seems to be cooling down, which is always good news for the market.
I see. So less inflation means less pressure on businesses and consumers, which could lead to stronger earnings and more spending.
Precisely. And to top it all off, there's even talk of potential interest rate cuts on the horizon.
Okay, so we've got a potentially strong economy, cooling inflation, and the possibility of lower interest rates. It's starting to paint a pretty optimistic picture for 2025.
It does. But hold on a second. I know you're going to ask
What am I going to ask?
You're going to ask about the track record of these long-term predictions.
Well, yeah, you're right. I'm always a bit skeptical of these crystal ball gazings. Didn't they predict the S&P would hit 5,100 last year?
They did, and it actually finished the year way higher at 5,882. That's over 15% higher than their prediction.
Okay, but what about 2022?
Well, for 2022, the prediction was 5,000, but the S&P finished 23% lower at 3,840.
Okay, see, that's what makes me nervous. It's like trying to predict the weather 3 years out. You never know what curveballs Mother Nature is going to throw at you. So should we just ignore these Wall Street predictions altogether?
I would say ignore them completely. While they don't have crystal balls, these predictions can give us some valuable insights into the factors that are likely to drive market movements.
So we should take them with a grain of salt.
Exactly. A big
Yeah.
grain of salt. Unexpected events can always throw things off course, remember.
For sure. Okay, so let's say we take these predictions with that grain of salt. What other pieces of the puzzle should we be looking at? The market is more than just a bunch of numbers on a screen, right?
Oh, absolutely. It's driven by the performance of real companies creating real products and services. And that's where things get even more interesting.
You're telling me the Motley Fool article highlighted some pretty impressive projections for company earnings this year. FactSet Research estimates that S&P 500 companies could see a 5.8% revenue boost and a 14.8% jump in earnings.
And remember, that's on top of the growth we saw last year.
Okay, now those are some impressive numbers. But before we get too carried away, I have to ask, are we talking about real sustainable growth here, or are companies playing accounting games to inflate those numbers?
That's a great question. And the answer, thankfully, seems to be that we are seeing signs of quality earnings growth.
Quality earnings growth. All right, you got to break that down for us. What exactly does that mean?
It means that the earnings increases are driven by genuine improvements in business performance, like increased sales and higher profit margins. It's not just a result of financial engineering or stock buybacks.
Ah, okay. So real, tangible improvements in how businesses are operating, not just some smoke and mirrors.
Exactly. That's what we like to see.
So for our listeners who are thinking about investing, how can they tell if a company's earnings growth is the high-quality kind? What should they be looking for when they're doing their research?
Well, the key is to really dig into the financials. Look for companies that are growing their revenue organically, expanding their customer base, and improving their operational efficiency. Those are the hallmarks of a company that's truly firing on all cylinders.
Got it. So we've got potentially favorable macroeconomic conditions, and companies seem to be genuinely performing well. It's starting to sound like 2025 could be a pretty good year for the market, right?
It certainly looks that way. But there are some wild cards that could shake things up.
Oh, wild cards. I was just starting to feel good about things.
Yeah.
Tell me more about these potential party crashers.
Well, the Motley Fool pointed to a few key areas of concern, and the biggest one is inflation.
Inflation, right? That's been the buzzword for the past couple of years, but I thought it was starting to cool down.
It is. But if it sticks around longer than anticipated, it could force the Fed to hit the brakes on those interest rate cuts we were talking about.
And that could have a real impact on market performance.
You would bet. It could make borrowing more expensive for companies, which could slow down economic growth and potentially hurt corporate profits.
I get why that's a concern. But how sensitive is the market to these kinds of changes? What could it mean for someone's investments if inflation throws a wrench in the works?
Well, that's where things get really interesting. We'll dive into those details after a quick break. The market sensitivity to inflation and interest rates, it's kind of like a dance.
Yeah.
They're constantly influencing each other. And the music can change pretty quickly.
Okay, I like that analogy. So if inflation is setting the beat, what kind of dance are we looking at right now? A waltz or more of a jitterbug?
Well, right now it's more of a cautious two-step.
Yeah.
The Fed is trying to strike a balance. They want to bring inflation down without causing the economy to completely stall out.
Right. Makes sense. And that balancing act has implications for interest rates, which then impacts the stock market. It's all connected.
Exactly. And how sensitive the market is to those changes really depends on investor sentiment. If investors get spooked by rising inflation or a more hawkish Fed, they might start selling off stocks, which could lead to a correction or even a bear market.
So for someone who's thinking about investing, this is a lot to consider. It's not just about picking the right stocks. It's about understanding the bigger picture and how those macroeconomic forces can impact their portfolio.
Absolutely. Individual stock performance can definitely be swayed by these larger economic trends. Take the tech sector, for example.
Yeah.
During the pandemic, low interest rates fueled a massive rally in tech stocks. But as inflation rose and the Fed started hiking rates, those same stocks took a pretty big hit.
Oh, yeah. That's a great example. It really highlights how important it is to not just focus on the company itself, but also on the macroeconomic environment it's operating in.
For sure. And it's not just about identifying potential risks either. It's also about recognizing opportunities. Like, for instance, if inflation does cool down as expected and the Fed starts cutting rates, certain sectors like housing and consumer discretionary could see a significant boost.
Okay, so it's about being aware of the potential upsides and downsides presented by these macroeconomic wildcards. But how can someone listening to this navigate these potentially choppy waters? What steps can they take to protect their investments?
Well, first off, diversification is key. Don't put all your eggs in one basket. Spreading your investments across different asset classes, sectors, and even geographies can help mitigate risk. You could consider investing in a mix of stocks, bonds, real estate commodities, things like that.
So don't bet it all on one horse. Spread your bets and diversify your portfolio.
Precisely. And another important point is to stay informed. Keep up with the latest economic news and understand how different events could impact your investments. That doesn't mean you need to become an economist overnight, but it does mean being proactive about your financial education.
Knowledge is power, right?
Absolutely. The more you understand about the market and the forces that drive it, the better equipped you'll be to make informed investment decisions.
All right, so diversify, stay informed. What else?
And here's a big one. Don't panic. Market fluctuations are totally normal. Even if there is a correction, it's important to remember that the stock market has always recovered over the long term.
Okay, but that's easier said than done, right? When you see your portfolio taking a dip, it's hard not to hit the panic button.
I know it can be nerve-wracking, but that's where having a well-defined investment strategy comes in. It's like having a roadmap that guides you through different market conditions. By having a clear plan in place, you're less likely to react emotionally to short-term market swings.
So stick to the plan. Don't let your emotions drive your investment decisions.
Exactly. And finally, remember that investing isn't a get-rich-quick scheme. It's a marathon, not a sprint. Building wealth takes time, patience, and discipline.
Words to live by. All right, so we've talked about Wall Street's predictions for 2025, and we've explored some potential wildcards that could impact the market. But there's another piece of the puzzle we need to consider, and that's the potential impact of AI. You mentioned it briefly earlier, but let's dive a little deeper.
Yeah, AI is a fascinating wildcard. It has the potential to be both a driver of growth and a disruptor.
And that disruption could have some pretty significant implications for investors, both positive and negative, right?
Absolutely. It's a bit of the double-edged sword. On the one hand, AI could lead to massive productivity gains, boosting corporate profits and driving stock prices higher.
We talked about how the Motley Fool article highlighted strong earnings projections for this year. Could AI be a factor in those projections?
It's definitely possible. As AI becomes more sophisticated, it could automate tasks, improve efficiency, and even create new products and services that drive revenue growth, which could potentially lead to even higher earnings growth than what's currently being predicted.
Okay, so that's the optimistic side. But what about the disruption part? What are some of the potential downsides of AI from an investment perspective?
Well, one concern is that AI could lead to job displacement. As machines become capable of performing tasks that were previously done by humans, it could lead to unemployment and economic inequality, which could have a negative impact on consumer spending and overall economic growth.
So it's not all sunshine and rainbows?
Yeah.
There are some potential downsides that investors need to be aware of.
Right. And it's not just about job losses either. AI also raises ethical considerations around privacy bias and accountability. As AI becomes more integrated into our lives, it's important to consider the potential societal impact and ensure that it's being used responsibly.
That's a really important point. It's not just about making money. It's about ensuring that AI is being developed and deployed in a way that benefits society as a whole.
Absolutely.
Yeah.
And from an investment perspective, it means considering the ethical implications of the companies you're investing in. Are they using AI in a way that's responsible, transparent, and equitable? These are all questions investors need to be asking.
So it's about doing your due diligence, not just on the financial performance of a company, but also on its ethical track record.
Exactly. And it's about recognizing that AI is not just a technology. It's a powerful force that has the potential to reshape our world in some pretty profound ways.
Okay, so we've covered a lot of ground today. We've looked at Wall Street's predictions, we've explored some potential wildcards, and we've delved into the exciting and potentially disruptive world of AI. It's a lot to process.
It is. But as the Motley Fool reminds us, history has shown that patient investors who hold on to quality stocks for the long haul tend to be rewarded.
That's a good point to remember. Investing is a long game. And as we navigate this complex and ever-changing market, it's important to keep our eyes on the prize and stay focused on our long-term goals.
Absolutely.
Yeah.
And remember, diversification, staying informed, and not panicking are all key to success.
So will the stock market soar or crash in 2025? Well, the truth is nobody knows for sure. But by understanding the factors that are likely to influence the market's direction and by making informed investment decisions, we can increase our chances of success.
And remember, the AI revolution is just beginning. It's a story that's still being written, and investors who can anticipate the trends and identify the winners stand to reap significant rewards.
So as we wrap up this deep dive, let's leave our listeners with something to ponder, something that builds on what we've discussed but wasn't explicitly mentioned in the Motley Fool article.
Okay, how about this? What if this bull market we've been talking about? What if it extends beyond 2025?
Ooh, good one. What if the factors driving growth continue to play out and the market keeps climbing? Could we be at the beginning of a secular bull market that lasts for a decade or more?
That's a fascinating possibility, and it's definitely something investors should consider as they develop their long-term investment strategies.
So for those of you listening, think about this. If the market does continue to rise for an extended period, what would that mean for your investment goals and your portfolio allocation?
It's an exciting prospect, but it also requires careful planning and risk management.
And that's where our deep dive comes to an end for today. But the conversation doesn't have to stop here. We encourage you to continue exploring these topics, do your own research, and stay engaged with the market.
Remember, the more informed you are, the better equipped you'll be to navigate the complexities of the market and achieve your financial goals.
Thanks for joining us on this deep dive into the world of investing. We'll be back next time with another fascinating topic and another opportunity to explore the market's hidden depths. It's wild to think just a few years ago, self-driving cars seemed like something out of a sci-fi movie.
I know, right?
Now they're on our roads, and a perfect example of how AI is ready to revolutionize industries. Think of the ripple effects.
It is mind-boggling, and self-driving cars are just one piece of the AI puzzle, right? Think about healthcare.
Oh, man. AI could totally change medical diagnoses, drug discovery, even personalized treatment.
Exactly. Like imagine algorithms that can analyze your DNA, your lifestyle, to tell you if you're at risk for certain diseases or even tailor treatments to your genes.
It'd transform preventative care as we know it.
Completely. And then there's manufacturing. AI-powered robots could make production lines so efficient, driving down cost-boosting output.
We're already seeing that, right? With those smart factories
Yeah.
where machines talk to each other and make decisions in real time,
Yeah,
like a futuristic movie.
it is pretty amazing. And let's not forget finance. I mean, the industry we're talking about today,
Right.
AI is already being used to detect fraud, manage risk, even give personalized financial advice.
Okay, so I'm getting it. AI is a big deal. But for our listeners who are thinking about their investments, how do they actually capitalize on this? Where are the opportunities?
That's the million-dollar question, isn't it? First, you got to identify the sectors AI will impact most. We've talked about healthcare, manufacturing, transportation, but the list goes on: retail, education, energy. It's huge.
So think beyond the usual investment categories and look for companies that are really using AI in new ways.
Exactly. Don't just focus on the big tech companies either. There are tons of smaller companies developing cutting-edge AI applications. They could be the next big thing.
It's like panning for gold, got to sift through the dirt to find those nuggets.
That's a good way to put it.
So for someone who's not a tech expert, how do you even begin to evaluate these companies? What should we be looking for?
First, look for companies with a clear AI strategy. What are they doing to integrate AI into their business or develop new AI products and services?
Okay, so a solid plan is key. What else?
Look at their talent. Do they have a team of experienced AI engineers, data scientists? AI is a specialized field. You want to bet on the companies with the brainpower to make their vision happen.
Makes sense. So it's not just about the tech itself, it's about the people behind it.
Exactly. And finally, consider their data advantage. AI algorithms need data to work. Companies with access to lots of good data have a real edge.
So if a company's got a treasure trove of data, that's a good sign.
Definitely. It means they've got the fuel for their AI ambitions.
This has been eye-opening. It feels like we went from a cautious two-step to a full-blown techno-tango.
Like that.
But as exciting as AI is, it's important to remember it's not a guaranteed win for investors, right?
Absolutely. There will be winners and losers in this AI race. Some companies will succeed, others will fail, and like any investment, there are risks involved.
So for our listeners, approach AI investing with enthusiasm, but also caution. Do your research, diversify your portfolio, and remember, patience is key.
Couldn't have said it better myself.
Yeah.
The AI revolution is just getting started and the opportunities are huge. But be informed, strategic, and realistic about what could happen.
Well said. So to recap, if the market keeps rising like we discussed earlier, you got to think how that affects your investment goals and how your portfolio is set up.
Right? You might want to rethink how much risk you're comfortable with and adjust your strategy.
And as always, the more you know, the better you can navigate the market and reach your financial goals.
The future is full of possibilities. So stay curious and never stop learning.
That's a great note to end on. Thanks for joining us on this deep dive into the world of investing.
Yeah, it was my pleasure.
We'll be back next time with another fascinating topic and another opportunity to explore the market's hidden depths.